Welcome back to the Dividend Diplomats YouTube channel. You got your boys here, Lanny and Bert, the Dividend Diplomats. We're going to talk to you today about two ETFs that generate a huge amount of passive income that can get you at least a 9% dividend yield that pays a monthly dividend. Guys, I bet you know exactly which two funds we are talking about today.
Smash that subscribe button. Give Bert and Lanny a nice thumbs up, guys. Here we are. It's Tuesday morning. Get that coffee flowing, guys, because guess what? We're talking about two massive passive income ETFs, guys. And we are curious if this is the right path of building passive income for you. Or maybe Bert's considering it right now. He is hot on the seat right now looking at these two bangers.
Yeah, maybe I am, maybe I'm not, but I know a lot of you in the community are always considering these two funds, which is why today we're going to talk to you about JEPI and JEPQ, ticker symbol JEPI and JEPQ, the option income ETFs.
Oh baby, here we go, guys. The tested JEPI, the tested JEPQ, good old JP Morgan.
Yeah, so we're just going to keep this pretty high level in terms of, we'll talk about what the option ETFs are, how does JEPI and JEPQ execute on them, how are they taxed, and just some facts about the two funds. And then at the end, if we feel like it, we'll talk about who these funds may be the best for at this moment in time.
All right, guys, here we go. We're looking at these two high yield option income ETFs. So what exactly is an option income ETF? Well, in the JEPI, JEPQ, they own a basket of stocks, each different basket of stocks. And the managers behind it are writing and selling covered calls on the positions that they own. So in a hot green market, especially like we have been, these ETFs do very well because the premiums are juicy, to say the least. And even if shares somehow get called away, that means there's usually a gain more than likely built into that. So there's a lot of income that's being generated from these ETFs in these green rising times.
That's right. Because they own those basket of stocks, like you said. Then they have these funds, these ELNs that they use to where they write the notes, where they get their premium going back and forth with these banks that hold the structures that pay the income back. So it can be a very lucrative piece. And so each time they write these options, they distribute these dividends and the income they've earned from these structures on a monthly basis to you shareholders. So that's where you get the monthly dividends from. You're getting a piece of that dividend income from your basket of stocks. Then you're getting all the distributions, you're getting all the interest earned from the covered call and the option writing ventures.
Yeah, and then obviously the taxation on these ETFs are a little bit different here, guys. So, they'll be more than likely taxed at your ordinary income rate. So keep that in mind when you look at the overall effective yield on the ETF. So multiply that by, 1 minus your tax rate versus 1 minus your capital gains or dividend tax rate.
Sure. And the caveat is here, you talk about massive dividends here. JEPI has a yield of nearly 9%. JEPQ has 11%. It changes on a regular basis. Even taxed at ordinary rates, Lanny, versus capital gains rate, you're still getting a higher income level than your typical dividend stocks. You're going to be 9% tax at ordinary is higher than 3% tax at a capital gains rate.
Now, again, one is built on the S&P 500. The other is built on the NASDAQ 100, guys. Both do have, there's also an expense ratio component to it, so 0.35%. Both are massive ETFs with over $25 billion in assets under management, guys. Now, again, the track record without dividends, the performance is not going to look great. I mean, 5 years, they're both a little bit over 10%. Both down year to date, guys, but that doesn't factor in the 9 to 11% dividend yields you've experienced.
No, if you're looking, these funds are never going to have an appreciation standpoint, and some of the appreciation for these funds are going to be capped because of this covered call strategy. Because a lot of the holdings are going to get called away when the market hits a certain price. So you might miss out on some of the potential upside, but you're picking that up on the premiums that are going to get distributed out in that yield. So that's why you see lower than market returns from the pure share price increase, but that's by design. That's how this fund is supposed to function.
Yeah, the biggest thing to talk about is, JEPQ built off the NASDAQ stocks. almost 10% exposure to NVIDIA, followed by Microsoft, just under 8%, guys. Then you have Apple and Amazon, both over 5%. So when you're looking at the first just 4 stocks already, the juicy amount of, almost 30% makes up just the first 4 stocks. So keep that in mind.
Yeah. Versus, when you look at JEPI, none of them are over 2% of the holdings. Sure, there are a lot of tech stocks in there too. But you also have, I think it's funny, you see Southern companies sneaking into the top 10, which you wouldn't really bucket up there with
What about those analog devices, though?
the analog devices. And you see Amazon, Train. Those are the bottom 10. It's funny that Oracle is the number one holding for JEPI versus NVIDIA at 8%.
Such a price surge. I mean, it's got to be.
Which is wild. Yeah, Oracle has been on quite the tear, hasn't it?
Yeah.
Yeah,
but because that's it. Monthly income ETFs, expense ratio above the norm, paying monthly, guys.
Yeah. I mean, even with an expense ratio, their expense ratios are 35 basis points. We trade our covered calls, our cash secure puts on public, which actually right now is giving us cheaper. Like we're getting money with rebates through there. But if you go buy options, if you're writing options on Fidelity, Charles Schwab, or any other regular brokerage, you're going to be paying some pretty high fees yourself. So in the grand scheme of things, the 35 basis point expense ratio, that expensive when you compare it to other option trading platforms? Probably not, but that's probably the scale at which they're able to do it and execute on where you can save on some fees.
Yeah, you could, essentially it's like you're paying somebody to manage a covered call portfolio for you in hopes of generating income for you guys. So that's actually a great segue into who is this for? Is this for the, coming out of the gates, you're 20, 21, 22, 25 years old. Should you be buying JEPI or JEPQ?
I think that's a fair question. And I would say there's one caveat to it. I think you said it in the last session. If you are looking to execute on an option strategy, but you don't necessarily have the time to do all that research, you don't have the time to find it and get those large premiums, but you still want to dip your toes into the options, you're comfortable with that 9%, 10%, 11% yield, which depending on which fund you pick, sure, Lanny, this is a great option for you. You don't have to manage anything. The options are done for you. Skin in the game, but you're not going to get that appreciation that you would if you're looking to be a growth investor at the age of 20, 21, or 22.
JEPI, it's in the game.
Yeah.
Kidding, guys.
No, that's great. The other one, though, is if you're close to retirement, you want to build that passive income stream. You want to get that income right now, and you don't care about the appreciation. You're focused on retirement income today. It's going to be a great source for you.
Oh, it would. And again, even if you just wanted to, as Burton was really diving into, at any age, even if you just wanted to devote 5,000, 10,000, 20,000 to this, and just that's it, and you just let it do its thing, then there could be a spot for that. Obviously not professional advice, but I could see that if you're 25, 45, or 65, you just said, hey, I'm going to put 20,000 into this and then, focus on the other stuff.
Yeah, it's great. I mean, they're great funds. Their performance is great. They're obviously one of the largest, and they're growing like crazy. So there's a market for them. There's great activity, and they're pretty well regarded by a lot of the investing community and a lot of professionals. So again, use your own advice. If you're looking to invest in them, fantastic. If you have already, we want to hear why you invested in them in that comment section below.
Disclosure, we do not each own any of them. So just, unbiased here, guys.
Yeah, I just honestly, it's something a lot of people talk about it in the comment section when we talk about other funds. So it's always fun to dive in and take a look at JEPI and JEPQ.
Yeah. So the guys, what other option income ETFs are you buying? Because there are many others now out there. JEPI and JEPQ were kind of at the forefront talking points, easy, common ones that everybody's been buying, almost like the Amazon, or I don't know what you would call it, of that section of ETFs, guys. There's plenty of others.
Yeah, I was going to call it like the realty income of REITs. How it's just they're the old reliable of the option income ETFs right now.
Yeah, so let us know if what else you own or you've been buying on that side of the fence.
If you haven't already, everyone subscribe to the channel. Give this video a thumbs up, and remember, you're either with us or you're against us, Jack.
That was Bert the Hurt and Lanny from the Dividend Diplomats, over and out.